All right, let's get right into it. Today, we're talking about a company that's a real star in India's IT scene, Persistent Systems. Now, everyone agrees it's an absolutely fantastic business, but here's the million-dollar question, right? Is it a fantastic investment at the price it's trading at today? That's the big puzzle we're going to piece together.
So I want to start with just one number. Seriously, one number that tells you so much about the quality of this company. And that number is 24. What does that mean? It means 24 consecutive quarters of revenue growth. That's 6 years, straight. In an industry as choppy and unpredictable as IT services, that kind of consistency, wow. It's almost unheard of. It's a huge deal.
Okay, so you see a number like that, and you're probably thinking, slam dunk, this has got to be a buy, right? Well, not so fast. We're actually putting a hold on this one. And the whole reason we're doing this deep dive is to unpack exactly why. It's that classic story. An amazing company that comes with a very demanding price tag.
So let's get into the first part of our story. To really get why the price is so high, you first have to understand what makes this company's growth engine just so elite.
So what's their secret sauce? What's their moat, as they say? Well, it all comes down to something called specialized software product engineering. Now, that might sound a bit jargony, but think of it this way. They're not just the IT support guys you call when your computer breaks. No, they are the architects and engineers who are helping other tech companies build the very core of their products. They're in the engine room, not just polishing the chrome.
And this is where things get really interesting, because that moat is deep. Since they're right there building the core product, they're not paid from the regular IT budget, the one that's the first to get cut when things get tough. Nope, they're paid from the essential research and development budget. That makes their client relationships incredibly sticky. It's like you'd fire the decorator long before you'd fire the structural engineer building your house, right? And it gets better. They were early to the AI game and have these deep partnerships with the biggest names out there: Salesforce, AWS, Microsoft, and even NVIDIA. So this moat isn't just deep, it's getting wider every day.
And look, the proof is in the numbers. This strong moat translates into some seriously impressive performance. Just look at that year-over-year growth. It's not just strong, it's actually accelerating, hitting over 25% in the last quarter. Now, I know what you're looking at. You see that little dip in the EBIT margin for Q3 and you're thinking, uh-oh, what happened there? Don't worry, that was just a one-off hit from some new labor codes. The important thing is, look what happened next quarter. Bounced right back to 16.3%. The underlying momentum here is absolutely real.
And here's the real kicker, the big payoff for all this brilliant execution. A return on capital employed, or ROCE, of 34.4%. Now, ROCE is just a fancy way of asking, how good is this company at turning 1 rupee of capital into profits? And let me tell you, 34.4% is an incredible answer. That number puts Persistent right up there in the top tier of all Indian IT companies. It's a sign of truly exceptional management.
Okay, so we've painted a pretty rosy picture, right? Best-in-class company, amazing growth, solid management. But, and this is a big but, every great asset has a price. And this is where we hit the main conflict, the central dilemma of investing in Persistent. You have to pay a very, very steep price to own it. And this chart right here, it just lays it all out in black and white. Persistent is trading at a price-to-earnings ratio of about 44 times. Now, to put that in perspective, the big guys, your TCS, your Infosys, they trade somewhere between 22 and 28. So you are literally paying almost double the multiple for Persistent. Yeah, the growth is higher, but wow, that is a massive, massive premium to swallow.
So this brings us right to the heart of the matter. It's the big question you have to ask yourself as an investor. Is this crazy high price actually justified? I mean, is the company that good? Or is this just a classic case of an overhyped stock that's gotten ahead of itself?
And when you pay a price like that, it means one really important thing. Your margin of safety is pretty much zero. Gone. Think of margin of safety as your safety net, your buffer, in case things don't go perfectly. Well, at a PE of 44, the market isn't hoping for things to go well, it's demanding perfection. So any little thing, a tiny miss on earnings, a hint of a slowdown, and this stock could fall and fall hard.
So you've got this high wire act, right? A premium price, no margin for error. Your entire investment thesis boils down to your faith in one single thing, the management team. Can they really keep executing this flawlessly? So let's ask the question, can you actually trust this leadership team?
And honestly, this is where the story starts looking really good again. What you're seeing here is basically a report card for the management. And they're getting straight A's. They said they'd maintain quarter-on-quarter growth. Check, they did it. They gave a target for their tax rate. Check, they nailed it. They promised strong cash flow. Check, they delivered. This isn't just talk. This is a team that consistently does what it says it's going to do. It's a real track record.
So, when we crunch all that data, it boils down to this one really powerful score, a management credibility score of 8.5 out of 10. And let me tell you, that is an exceptionally high score. It basically means that when this team tells you they're going to do something, you can pretty much take it to the bank.
And this quote from the analysis we're looking at just sums it up perfectly. It says, management underpromises and overdelivers. They flag macro headwinds honestly in advance rather than after the fact. Think about that. How many companies do you know that tell you about problems before they hit the bottom line? Most try to hide it. This team, they're upfront, they're transparent, and that kind of honesty is so rare, and it's what builds real, long-term trust with investors.
Okay, so let's put it all together. We've got an elite business, we've got a management team you can absolutely trust, but we have that sky-high price. So what do? How do you actually invest in a situation like this? Let's break it down into a really simple playbook.
All right, here's the bottom line. It really comes down to two scenarios. First, if you already own shares in Persistent, the advice is simple. Just hold. Don't touch it. Truly great companies are rare, so you just let the magic of compounding do its work. But what if you're a new investor looking to get in? Well, for you, the playbook is different. The advice is to wait. Be patient. You want to see a dip, maybe 10 to 15%. Your target entry point should be somewhere in that 4,500 to 4,800 rupee range. That's the sweet spot where you get to own this amazing company, but with a little bit of that margin of safety we talked about.
And there you have it. That's our full breakdown of Persistent Systems. A fantastic business, no doubt, but one that's trading at a very full price. Hey, if you enjoyed this deep dive and you want more analysis just like this, do us a favor and hit that subscribe button. It really helps us out.
And of course, we have to end with the standard disclaimer. Just a reminder that this is all for educational and informational purposes only. We are not SEBI-registered advisors, so this is not financial advice. Please always do your own research and double-check all the data before you make any investment decisions. Thanks so much for tuning in.